It does feel like this bizarro world where on one hand, we're talking about the Fed cutting and continuing to cut, labor market weakness, and equity prices at all-time highs and spreads at all-time tights.
Yep.
Is there some real tension in that?
I think, look, the tension is on the inflation front, right? The Fed's already told you they're going to miss their mandate for 7 years in a row. Probably very few of your viewers have invested in a period like that. The offset of that is there's not a lot of supply in the market, and the S&P is being bought back $1 trillion, $1.5 trillion, and we see a lot of annuity buyers coming in, keeping credit spreads tight. The other thing is, I think this is a lot like the 1990s where we were getting a productivity boom. And so when you look at the S&P kind of revenue per employee, it's breaking out. It's breaking out to the upside. The market is picking up on that. I'd say today, I think the U.S. market will continue to perform. We're probably most excited about, on the margin, what's happening in Asia. There's a ton of corporate reform taking place in Japan. That's been our second most active market. Korea, cheap market. They're trying to follow the Japan playbook. And even China, I go there all the time. There are things that are starting to signal that Xi maybe appreciates this intersection between national security and economics, and the stock market's doing a little bit better. So as the dollar weakens, I still think the U.S. is the market that you want to be in, but on the margin, I'd be taking a little bit more out and going internationally, particularly around those three markets I highlighted in Asia.
We're going to talk about Asia and trade in a moment. We're going to bring in our reporter in Asia with President Trump. But I want to focus in on the 1990s comparison. Okay. We had Paul Tudor Jones on here earlier this month, and he made the same comparison, saying, October of 1999 is a lot like October of 2025. And of course, the NASDAQ still had a long way to run at that point, right? Still doubled into March of 2000. Do you think we're in that same kind of bubble-ishous environment?
I think it's earlier stage. When you look right now, the CapEx and the R&D around AI is about 5% of GDP. Typically, it usually gets around 7 or 8% of GDP when you have a real bubble. So I don't think we're quite there yet. I think you'll hear from all the earnings today, the companies have to spend on this. Ultimately, over time, I think the value is going to shift from the enablers of AI, which is utilities, industrials, and tech right now, to the applications of AI. And that probably will be more broad-based. That's exactly what we saw during the 1990s. But very similar, in 94, you had a bond market upheaval. That was 2022. People moved to the sidelines. Everybody's been calling for a recession the whole time. We've had terrible manufacturing data, but the services economy is doing well. And a little bit on the manufacturing side right now, it's hard to hurt yourself falling out of the basement window. I mean, we're already at pretty low levels. We have a pretty interesting window. We own 150 to 200 companies. We continue to power forward. I would say some of the hiring is moderating. The government data, when it does come back, will look a lot worse, because ultimately DOGE will take the government jobs down, and that's somewhere between 1/3 and 1/2 of jobs. Right? I think people haven't focused on that. So the headline data may look worse than what we're seeing at KKR, or the weekly jobless claims, or what you see in ADP, which are all reliable sources.
Yeah, I know in September you had written that had it not been for some of the supply issues with labor, we would have been looking at an unemployment rate that looks something like 5%.
Yeah.
And it does feel like every day there's a new headline like X company is letting go of workers. Scott Kleinman told Matt and I yesterday that the question being grappled with right now is to what degree AI is responsible for some of those replacements, especially when you look at KKR's portfolio companies. Is there a real trend of that happening?
So let's start with the public data. Remember, the single biggest driver has been healthcare and education. It's been about 100% of job growth over the last 12 to 18 months. So when you get the big headline number, you really have to dissect it, and what you see is that sector has been the main driver. You are to your point, you are starting to see joblessness in the college grads. They're having a harder time getting jobs, and then the government is what I said. What's happening though in the headline level, though, remember, it's not just demand slowing. The point you're making is an excellent one, which is what we were flagging, is the supply is slowing. So it affects the denominator, which makes the unemployment rate, if you adjust for that, actually closer to 5. And so if I'm a Fed governor right now, I've been trying to have the swivel between inflation and employment. And I, until recently, have been much more focused on inflation. What I think we've been signaling, on our cuts and our forecasts, is that they need to shift to employment. I think the absolute level of rates in the U.S. is too high for the economy right now. You see this in the low to middle income spending, you see this in leveraged structures, and ultimately you see it in housing. Those are all critical variables to the economy. So I think the Fed needs to cut. I also think they need to signal that they're going to stop QT. And we'll probably do that at a level that's a lot higher than what we've seen in the past. But I do think the inflation story is going to be, this higher resting heart rate for inflation this cycle. You guys have been reporting on this, and I think you've been spot on, which is this time it's different, right? We've been talking about this regime change at KKR where you have bigger deficits, more geopolitics, messy energy transition, and stickier services inflation. That's why I think even though they lower rates, they don't go back to the lower bound that all the reporting you've been doing for years, that you can kind of throw that playbook out. And why is KKR doing more in infrastructure? Why are we doing more in corporate carve-outs? Why are we doing more in asset-based finance? Those are all products that should excel in a world where you have higher nominal GDP and higher inflation. And I think the Fed is going to be forced to cut into that a bit, not as much as the bulls think, but they're going to have to continue to bring the absolute level of rates down. It's not about financial conditions. They're pretty easy right now.
Right, they are. I mean, I look at FCON Go on the Bloomberg terminal all the time, and they look pretty easy. My question is, lowering rates will help maybe someone buy a house or maybe help someone buy a car, and Lord knows they need the help because the prices are so high. But will it bring jobs back if AI is replacing those jobs?
I think there are a couple of questions in there. One is we can't celebrate rates being cut because when they went as much as we did in the past, the beta to rates was much higher, right? Because remember when they raised rates, most consumers had termed out. So on the way down, it's not like it's going to change overnight, that you get just the benefit and none of the pain. So I think the easing of rates will probably affect 26 and 27. On the AI stuff, I have a little bit of a different view, which is I don't think it's going to, this is what people said in the 1990s with the internet, is going to disintermediate all these jobs. I do think certain industries are going to be under a lot of pressure, but at an aggregate right now, we need workers in the U.S. I mean, one of the key themes, I go all around the world traveling, going to KKR's offices, meeting with companies. The demand for skilled talent right now is at an all-time high. And so what are the big themes, investment themes that come out of that? Worker retraining. We've been doing a lot around that from investment. Employee ownership. We're doing a lot around that. Productivity enhancements. There's a lot. I mean, you can come in every day and say the glass is half empty. I think we've been saying they're writing, and is that the glass has been half full because there are lots of areas that serve as foils to all the madness that you guys have to report on.
Henry, just quickly though, if it is the 1990s and the ramp up, couldn't a glass half empty be that there is another side to this, that we go too far, and if it's an economy becoming more dependent on AI, then the downside looks ugly?
So we're going to get there because typically what happens is capital overspends. I would just caution that when you look at just the capex and AI in the first half of the year, it was greater than all the growth in personal consumption. That's a huge number. So these things tend to play out, but they take years, not months. And so I would caution on trying to call the top in the fourth quarter of this year. Ultimately, though, what will happen is returns get diminished because capital comes in and competition increases. And that's the law of the jungle in terms of financial services. And that's probably what's going to happen. But I don't think that's today. So what should we be doing for our LPs and that we invest on behalf of is we should be high grading who our counterparts are, finding the companies that really have real cash flow. Don't speculate. Don't adopt the thesis of if you build it, they'll come. That's what happened in 2000 and happened in 2001. What KKR is, and we were talking about this before the show, we're doing a lot of structured deals right now where we're getting guaranteed cash flows, and that's the way you mitigate some of the downside. So I can't speak to the overall industry. There's a ton of capital coming in. I would also say this whole notion of the private markets are becoming more like the public markets. Linear deployment, diversification, correlation, all those portfolio tools that have been in the public markets for 20 years. When I joined KKR in 2011, our portfolio managers really started to implement that, and I think it's kept us out of harm's way, and I think that's where the industry's going.
I was reading your thoughts from the road, and you were in Japan and China. Yep. What are your takeaways from the news we have today, and how does that dovetail with your experience in Asia?
Look, I think the Asian markets are going to perform, weaker dollar. I think the news that was just reported is what we hear on the ground. Everybody I met with in China said there's going to be a deal. So I think tariffs come down 20 or 30%. I think the two entities, particularly President Trump and Scott Bessent, want to get a bigger deal done. And then you have the hawks, both Republicans and Democrats, under them. I think they'll probably have the potential to do a little bit more, because I think the two entities need each other. We need rare earths, and ultimately they need to boost their technology infrastructure. And so I think they're going to try to find a way to meet in the middle. I don't think it's going to be perfect, and will be tension. And we clearly have left the decades that I used to go there, where China was going to consume or China exported. This is a very different China that we see right now. They're huge in industrial automation, they're huge in digitalization, and they're really big in the green economy. I think they're going to continue to export that, and that'll create a little bit of a deflationary impact on the world. But even with that said, I think these two entities at the top level want to try to get something done, and I think the markets, both in the U.S. and in China, have been responding to that. Japan, on the other hand, that continues to be our go-to market. Big corporate carve-out market, going back to Abenomics. They wanted to make that better. We've turned over a lot of prime ministers recently, but the corporate reform story is alive and kicking, and it's an incredibly powerful story. Cheap financing, negative real rates, people need to invest, and the corporations want help making their businesses better. So that's a good backdrop. It's a great backdrop for what we do.
And I know KKR has been very active there. Henry, I have in my mind a chart that you put out earlier this year, and it looked at a bunch of different asset classes, be it private capital, cash, or the global ag. And if the spread was like this in years past, the chart you had is, here's where we are going forward. Everything is going to start to compress. Does that suggest it's just an environment where, one, we should expect lower returns, and two, alpha's just harder to come by?
One, I agree, one, I disagree. On the lower returns, I would agree with you, Danny, that I think that you're starting with higher multiples, rates are lower, and margins are high. So that by mathematically, your expected returns go down. I actually think the alpha opportunity is higher. You're starting to see this in hedge funds. They're starting to perform again. Macro managers are doing well. And what we're doing is the bread and butter of what KKR does, many more corporate carve-outs. So if that's not what you do well, that's going to be an issue. Public to privates. There's a lot of stocks that have been left behind. You spend a lot of time reporting on the stars. What's happened is a lot of companies have not performed. They want to go private, be out of the limelight, and they want to use that capital. They want to use KKR as a partner to grow, or you're seeing what you reported on with Harley-Davidson, or what we talked about, just recently with the Dr. Pepper, where these companies are splitting up and they want to have a better corporate footprint. That, this whole idea of going from kind of capital heavy, lower multiple to capital light, or some type of accelerating growth. When you divide the S&P into its returns, the companies that are growing faster with the higher return on capital are getting the bigger multiples, and CEOs are waking up to that, and they're coming and partnering with us, and they're repositioning their footprint. So I think corporate M&A is going to pick up. I don't think it's going to go back to the boom times, but I think the corporate repositioning story, we're already in one of the strongest bull markets that I've seen in my 35 years doing this.
I want to ask the difference between the Middle East and Asia, because you've been to both regions a couple of times already this year. And when I do a story on PE and doing a corporate carve-out, they always seem to have a Middle Eastern partner lately. And that's different from what we saw in China and Japan, right? So what's it like in Saudi and the UAE? What's the opportunity?
So I would say that region, and there's obviously a big conference going on there right now, I would say that region is going from being just an area where people raise money to one where people are investing in that region. You've seen that with the appointment of General Petraeus at KKR. We put almost $2 billion to work in the Middle East around fertility, aircraft leasing, as well as pipelines. So that area is starting to grow. The third point is what you talked about, which is Middle East entities are starting to invest and become part of the private equity mix, and you saw that with EA. I think there's going to be more of that. So I think that there's a leveling of the global competitive landscape, and it's about, again, how do you create operational improvement? How do you think about the strategic industries that you want to be in? Clearly, Saudi thinks that EA is a strategic asset, and so I think you're going to see movement around in terms of where capital goes, not just fundraising going to the Middle East and being handed off, but ultimately partnerships between U.S. firms, Middle East firms, other types of things like that, where people invest in that region. They need expertise in the region, they need capital in the region, but they also want to take some of their capital abroad, and that's really what we picked up on the ground.